Good morning and welcome to the i3 webinar on long-term private capital co-hosted with IFM Investors. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. Today we will be looking at buy and hold strategies. And usually when I think of these strategies, a quote comes to mind of the long-term investor and growth pioneer Philip Fisher, who has been quoted as saying, "The best time to sell is almost never." So we'll look at how close we can get to that time frame. Now, we would like to make this webinar interactive, so please feel free to ask plenty of questions through the question box, and we'll try to cover as many as possible. As a disclosure, we do mention that this webinar is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. So our guest today is Jeremy Larkin, who is the head of long-term private capital at IFM Investors. Before joining IFM in 2019, Jeremy was a senior investment banker with more than 25 years experience in some very large scale mergers and acquisitions. Jeremy has also been a long-term advisor to several ASX 200 companies, state and federal governments, and super funds, of course. He will give a short presentation on IFM's take on long-term private capital and where it fits with other asset classes, after which we will open it up for questions. So Jeremy, welcome to the webinar and please dive straight in.
Great. Well, thank you, Wouter, for having me, and for everyone on the webinar, thank you for attending. I'm delighted to be here. I just put together a few slides to put in context what long-term private capital is. Which hopefully will facilitate the Q&A that is coming. So Sophie, if you could turn to the next slide, that would be helpful. So what is long-term private capital? Well, in our view, we believe it is focused on economically durable operating assets. We take an IRR-focused approach, which enables us to focus on sustainable value creation. That's both in terms of shareholder value and ESG, and we believe both are interlinked, and the long-term time frame enables us to do much more and deliver better outcomes for our investors. We think long-term private capital is actually a very good partnering tool for family companies that are seeking generational succession, or for multinational companies that may have very large enterprises in the Australian region, but would like to take some capital off the table and deploy elsewhere. And the reason why we think we suit those particular groups as partner relative to, say, traditional buyout funds is we will not end up with asymmetric timeframes, i.e. we're both seeking to hold over the longer term rather than partnering and then aiming to have an exit within 3 to 5 years. Another key benefit of long-term private capital is there's less churn. That, as I've mentioned before, enables to take a longer-term view for sustainable value creation, but also means that there's less fee leakage in the structure in terms of multiple payments to advisors such as bankers and lawyers as we enter and exit. And there's also less disruption for management teams who only generally getting their feet under the table, getting the business settled, and then they are focused on the exit. I think there's some quite interesting examples actually of businesses that have been through private equity hands multiple times and could actually well suit the long-term private capital strategy. So those type of businesses in an Australian context would include MYOB, Healthscope, and Icon Healthcare, which people will be aware recently sold. Next slide, please. So when we think about a business that we're going to hold for a long term, I think it's very important in our view that we focus on assets that are defensive but have growth options embedded. So we're not seeking to invest in a bond, we are seeking to invest in business that we can actively manage. But in doing so, we want the businesses to have very high cash flow conversion. And the benefit of that is that we can redeploy those funds back into the business, primarily to support organic growth initiatives, but Also M&A opportunities, should that be appropriate. And then should that not be available, in our mind, we would distribute the cash flow back to our end investors. And we're also very mindful that over this period of time, it is best that we focus on assets that have limited either regulatory or risk of disruption, given the time frame. Maybe we could move to the next slide, please. Now, we find this is a very interesting slide when we talk to our investors. You know, it enables us to highlight a risk spectrum and talk about risk-adjusted returns. Look, in my experience when I was a banker, you know, it felt like the listed market spent an incredible amount of time focusing on risk and how it differentiates from one asset to another. But when it came to the private markets discussions, we tended to end up in buckets. And we're at one end, which we can see on the left-hand side of the slide, where we're in very stable defensive assets in the infrastructure world, where people were happy to take or accept returns in the order of 8 to 10% and put scale dollars, you know, in many cases, many billions of dollars to work in that asset class. And then at the other end of the scale, we move to traditional private equity or beyond, where we have venture capital. And there, you know, the mandates generally require people to target 20% IRRs, notwithstanding what the operational risk may be and notwithstanding what the financial distress risk may be. And that's the mandate. But in between, there are a whole range of high quality assets that could be purchased and available into the private market investment sphere, provided the risk is priced appropriately. And maybe the next slide, please. And then just to put in context relative to the listed markets, like traditional private equity, the listed markets will, in my view, will always be here, and they play a very important role in the investment spectrum. However, the key issue with listed markets, and you know, it's a factor of the liquidity that it brings, is the short-termism approach that is adopted both by the market and then in turn can often drive decisions by management and board. And so that provides quite a key agency risk, which we think the long-term nature of the investment in LTPC mitigates. LTPC also enables us to focus on appropriate commercially focused governance, where we are working to improve shareholder value continuously, rather than what at times can become quite a governance burden in the listed markets. And then maybe if you just turn to the last slide, and without running through each of these, we've just highlighted a range of sectors which we believe fits the LTPC strategy. Thank you, Walter.
Excellent. Well, thank you very much for that, Jeremy. And as a reminder, please feel free to ask some questions through the question box in the app. But maybe I can kick off with a few questions myself. So we started off with this concept of the long term, and there are different interpretations of what the long term constitutes. Now, I believe when we look at how you look at this strategy is you take a very long term, 10 years plus. Can you tell me a little bit about why that long, why the time frame, and how you sort of define the long term?
Yeah, so that's our view, and I think you'll find most of these strategies have a time frame of at least 10 years, and in terms of the assets you're investing in, they tend to underwrite for 10 years. We also underwrite for 10 years, but ideally what we're looking for is assets that we could hold in perpetuity should the fund structure allow that out. And certain funds actually do have a perpetual time frame. As I said, we are looking for the assets that suit that type of time frame, and it enables us to take a longer term view on value creation. So as I said, there's an important element or important role that traditional private equity plays, but what it tends to do is there's a very short sprint upon entering into the investment. Lots happens, lots of restructuring happens, lots of management change, and generally all for the better. Management then gets stabilized, and then the focus from the investor is on exiting. In that business, though, there can often be things that if you didn't have an eye on the exit in the next 2 years, you would actually deploy significant capital, which could be deliver quite an attractive IRR outcome. But if you deployed it now and it takes 3 or 4 years for the returns to come, then generally what happens is people will highlight that in the selling documentation and leave that to the next investor, and generally that needs a new management team coming in who may or may not transact on that strategy that's been considered.
Yeah. So one of the sort of criticisms we hear sometimes on the long term is that it's very hard to predict out at 10 years. How do you sort of deal with that situation where maybe over the next 12 months it's sort of relatively straightforward to see where revenues and cash flows are going, but the further you extrapolate, the fuzzier the crystal ball gets?
Yeah. Look, that is true. I think we probably start with our investment criteria in terms of what type of assets we selected. So they're on one of those pages that I highlighted. So we are looking for businesses that exhibit strong defensive characteristics, have limited disruption risk, unlikely that there'll be material regulatory intervention, and generate lots of cash that we can redeploy into the business. So I think the main thing is we think very carefully about how this business, what type of characteristics the business has, and why that lends itself to the to the long-term investment.
Yeah. So you've done in the past some very, very large M&As. Is that sort of indication of what we can expect in this type of context, or what sort of assets do fit best with this type of time frame?
Yeah, so look, I think for LTPC, they will be more sizable and more mature businesses that investors will invest in, as opposed to, say, venture capital, or growth fund investments, which are seeking, significant capital to get them up and running and take them to the next phase. These are mature businesses. Like, I think we will find the range of mature businesses that may have been sitting inside large corporations that have been unloved, and often that's dealt with in the public markets via demergers. This is certainly an alternative that we can bring private capital and focus and create a sustainable business.
Yeah, I think you've also looked at companies and businesses that have been owned by private equity before. Is there still value in those type of businesses?
Yes, look, absolutely, Data. I think it's it's always, when we talk about value, it's always a matter of pricing the risk appropriately. And one thing we will do is we won't say something is automatically 8 to 10 or 20% plus. We will systematically review risk, price it at a liquidity premium. But as I mentioned in my opening remarks, there are a number of assets that trade regularly from one private equity owner to another. And there are often reasons for that, throughout the terms venture and growth capital. Partly it might be the transition where businesses are growing and they need a certain type of capital and they're mature, and then there's the next type of owner. So I think Icon's probably a fairly good example of that. Like, that's been through, it's now into, I believe, its third ownership by private equity or private capital. So, it started with a traditional private equity fund. It then was sold, and there's some international investors came on board as there was a strategy to grow outside Australia. And then recently it traded again, and we saw a different form of capital come into play, and that form of capital actually has a long-term horizon. So
yeah, I think one of the criticisms of traditional sort of private equity is also that it's sometimes when you are a big institutional investors, like most of our audience, is that they have multiple funds, and sometimes one gets sold to another fund, which has no net outcome for the actual investor. Is that an objective as well with taking the very long term, that you sort of avoid that for your clients?
Yeah, look, I think it mitigates that, and so it does mean that once people are in an investment, then they know it's going to be held for long term. That the investment manager, needs to make sure they're actively managing and delivering the returns. But you won't have the situation where LPs may be investing in different PE managers in obviously different proportion, but no doubt there have been circumstances where they may have been in fund manager XYZ who sells to fund manager ABC, and a large LP is sitting in both, and the ownership percentage may have changed, and then it's actually been value dilutive because at the minimum they've paid out fees to advisors, and then there is a period of disruption as you transition management teams. Because traditional PE generally has the management team move on at that point.
Yeah, so we've got a question from the audience here, which sort of is about the previous answer you gave with the example of the company. So can you give some examples of other prospective company candidates, and will they tend to have lower long-term multiples?
Well, they tend to have lower long-term multiples.
Yes.
Look, I don't think the multiple is a function of risk and growth. When I think about how we value a business, if you want to have a shorthand to come up the multiple, it's 1 over R minus G. So what is the risk, and then what's the growth, and then that will reflect the multiple. So I may not be quite answering the question, but I think the multiple will always be an output. At the risk of going on a slight tangent, when infrastructure investment started in this country, people were not sure how to price the risk. They didn't understand the growth options, but they were very much IRR focused rather than multiple focused. And we saw, as people actually became more comfortable with assets, those multiples tended to increase, but people had a much better understanding, and those assets delivered a good outcome. In terms of the type of assets that are out there at the moment that may suit, I don't really want to sort of run through a pipeline, but I'm conscious there's press that helps me. But at the right price, an asset like Loscam might actually suit long-term private capital. Loscam, again, is another good example of an asset that's been through multiple hands of private equity. When it was actually quite a small business, it was sold out of one private equity firm to another, which happened to be Affinity, and then that was sold to a group which is China Merchants, and they brought in a range of financial investors offshore, and then there's speculation that's going to be sold again. So for those, I'm speaking on the basis that people are familiar with Loscam, but Loscam is a quite a simple but complex business. It's embedded in the supply chain. It's a pallet business and its main competitor is CHEP, which is owned by Brambles.
Yeah. Now, I think when you make a purchase, you don't necessarily always go for 100% acquisition or even a 51% acquisition. Can you tell me a little bit about sort of the size of stakes you're after, and how you still think you can have influence over the business?
Yeah. So look, obviously different investors will have a different approach, but broadly we think long-term private capital is a good partnering tool. We think that focus on family enterprises, and I believe Australia is going to go through quite a generational change, as we've seen considerable prosperity built up over the last 50 years, and businesses that were perhaps created 3 generations ago, are now falling into the third or fourth generation hands. And, that's led to, disbursement of the ownership interest and generally people not being active in the business. They have significant concentration risk in that investment. Whilst it may have been very successful, that's how you generally create, lots of wealth, but it's not good because it enables significant risk. So you generally need to diversify. So LTPC allows them to partner, have a similar time frame because they've clearly been long-term investors, provide them with liquidity, and provided there's appropriate governance that sits between us as an investor and the family concerned, then we can protect our investor interests, make sure we are actively involved in the business and assisting with the shareholder value outcomes that we all should be aligned to.
Yeah. Now, often traditional private equity is also associated with high levels of leverage. Can you tell me a little bit about how you think about leverage?
Yeah. Look, and that goes to a comment I made earlier that in traditional buyout land, the mandates tend to say you need to make a return of 20%. And given that's where the focus is, if you're reviewing an investment opportunity, you've really got two key levers. One is the operating case, and then is the amount of leverage. When Australia tends to have less leverage in its buyout structures than offshore jurisdictions where they have all sorts of structures that different types of debt that can be put into the structure to assist in achieving that IRR requirement. But in terms of long-term private capital, we need to make sure there's a sustainable view on leverage so that we don't get caught, even though we're carefully targeting the type of assets we're investing in, there's always an economic cycle. So we don't want to be caught being over-levered at the wrong point of the cycle. The other thing we are very focused on is that we're not trying to buy a bond. We're buying businesses that we can invest in. And so we want to be able to have cash flow available that's not just going to service debt, but is adding value over the long term. And that could be material CapEx or material OpEx that needs to be spent. And then finally, once the investment is, working on the basis it doesn't need that material CapEx or OpEx or acquisitions, then we want to be able to pay dividends or distributions to our investors. So we don't want to be locked up in a complex leverage structure that prevents us from doing that, which is, when you get into higher leverage scenarios, then quite rightly the financiers are focused on no leakage outside the system. They want it all to be going to retire the debt.
So do you foresee any circumstances where you get more up to sort of the 6 times leverage that we see in traditional funds?
Look, without putting a specific number on leverage, because like I mentioned, we're going to price risk appropriately. We will look at all the credit metrics appropriately, and different types of businesses can carry far more leverage than others. In the world of infrastructure, it has not been uncommon for people to put 9 to 10 times leverage on those. If you look at that through a traditional private equity lens, you sort of say, wow, that's an extraordinary amount of leverage, but it's because of the nature of the assets they can carry that. So I think generally, Wouter, we will look to carry about 3 to 4 times leverage in the investments we're in, because that provides us the flexibility. However, it may be we take a slightly more aggressive view on the way in, because we can see the cash flow conversion is high, and we want to maintain a dynamic capital structure along the way. So we don't want to have it reducing to too low a point immediately. And the other time that we may take leverage up above that sort of target range is if there was a major CapEx opportunity to fund organic growth, or if there is an opportunity for an acquisition. So we at that point would probably take the leverage up, and we would cease distributions to our investors until the leverage came back to a sustainable level. And I contrast that with public market companies, and I was involved in a lot of acquisitions of public market companies and raising equity concurrently to fund those acquisitions. And when we raised equity to fund those acquisitions, generally when we raised the new equity, it was effectively come dividend, in that we might have been raising in May, but we were going to then pay a dividend in August, and the new equity would be a beneficiary of the dividend that was coming in August. So in some respects, we were just giving investors their money back in a less tax effective form. So we've raised capital, we've paid out income. Yes, there's franking credits, but there's still a tax impost. So because we don't have to pay a form of distribution every 6 months, we will use that to our advantage, which should enhance shareholder value over the longer term.
Yeah. There's another question here from the audience, which comes from sort of the background of how this sits in a multi-asset portfolio. So when institutional investors think of taking an allocation to LTPC, where should they take it from? And there's a couple of options that are listed here: private equity, listed equity, infrastructure. I presume some will take it just from cash flows, but if you have to take it from another class, where will you take it from?
Yeah, look, that's a very interesting question, Wouter, and one that we've had regularly when we've been talking to investors. And without being critical of participants in the investment community, that when you think in buckets, then that's the default. It's like, which bucket am I trying to put it in? If you take a view that I'm just investing across the risk spectrum, right? And I mean, the page I presented is really just private markets, but we think about investment risk more broadly. People invest in gold, people invest in bonds, people invest in real estate, and then they invest in a lot of the things that we've talked about. So if you think about it, like ideally, people would say, well, it doesn't just stop at 10% and restart at 20%. There is a risk spectrum through along that continuum. Look, that is the ideal path, and we've probably had the most productive discussions with people that take that view. But we've also had discussions with people who have been had more of an infrastructure bent, and I think through their lens, they look at what we're proposing and they say, you know what, this is actually not that materially different in risk from the type of risk that we take in infrastructure. So whether that be through COVID, airports or toll roads, where activity reduced materially, that was true operating risk being demonstrated in those traditional infrastructure assets. A lot of the things we've looked at, and hasn't been many great things about COVID, but from an investment point of view, one of the great things about COVID, a lot of things we're tracking have actually continued to perform very well and did not actually suffer as materially as the infrastructure assets. So a number of the people who have an infrastructure background say, hey, the risk in this asset class is not materially different to what I'm taking on in infra, but I can actually take a materially higher return than what I get in infra. So those type of investors think this is a great opportunity. And this is priced somewhere between traditional PE and infra. I think people that come from a lens of more traditional private equity struggle because their mandates that they give, that LPs hand out to the GPs, says it has to be 20%, and it's very hard to think outside that. But acknowledging in infra, they'll put billions of dollars to work. And in private equity, if they put a $50 to $100 million commitment, that's a really big commitment. And then really the third group of people we end up talking to at LPs, and not every super fund or pension fund around the world has these groups, but a number of them have innovation groups who sit above the asset teams or the investing teams and are trying to find new approaches and where to deploy. So again, we've had pretty productive discussions with those type of groups.
Yeah, so I suppose to a degree it's sort of a risk question, because if you base it on the assumption that you don't want to change the risk profile of your fund, you're looking for assets with similar risk profile. And I think you sort of mentioned this sits in sort of what some people call a mid-risk type of allocation.
Mm-hmm. Yes, look, we always think about, I probably should have used this term before, but we think about risk-adjusted returns. So for the particular investment you're making, what is the appropriate risk? And, you know, provided you price it appropriately, and ideally you are pricing it so you're going to get a return on that risk that over and above, so you can, you know, take care of your liquidity and hopefully generate alpha, then you should be accepting of that risk.
Yeah, I wanted to go a little bit into governance. You mentioned that the long term allows you to spend more time on governance, and I think in the past I've heard some criticism around traditional private equity where you have sort of this 3 to 5 year time frame, but you really have to take 2 years off that, because 2 years before an acquisition, people are not going to change the strategy. You've got a lot more time. How does that translate in sort of your engagement in that governance piece?
Yeah. So that's exactly right. As I said, there's a real role for traditional private equity, and they've been successful, and no doubt many people on this call have invested in those funds and they're delighted with the return. So we're not here today to say you should not continue to do that, but the point you make is the right point. It is a bit of a sprint when you go in. You're going in to work out what needs to be restructured, what are the key levers, how quickly can I get it done, and then, you know, when can I be on the path to exit, because that delivers the best IRR outcome. So management get very focused on the 100-day plan, and then implementing the key initiatives in the next couple of years, and then they turn to, well, it's time to exit. What are the paths? You know, am I going to an IPO? Am I going to a trade sale? Or probably from that, you know, management's worst outcome is I'm going to a dual track process where I'm doing both an IPO and a trade sale, and that means they can do nothing other than focus on the sale rather than on the business. So in terms of long-term private capital, like the exit time frame is pushed out such a long way that you move well beyond the 100-day plan. You would move well beyond implementing the initial initiatives that were identified in DD and the 100-day plan and taken to the next level, to setting up sustainable value creation processes. Now, that, as I said, it could be investing a material amount of money in a new manufacturing plant, if you're thinking in a traditional type of businesses, that will have a longer term IRR outcome. It could be, if say you're in a logistics business, could be taking view, I'm going to transform the ESG footprint, and I'm over a 5 to 7 year period, as I turn out my fleet, I'm going to electrify the whole fleet. Now, really hard to do that in 2 years' time, but in an LTPC strategy, you've got plenty of time to do that. So, you know, midway through your investment period, now you've got an entirely electrified fleet, and then you can turn your, you know, you've got your next 3 to 5 year plan, and you're upping the ante on that. Look, we talked. There's a question asked before about the type of example of assets. Another one that comes to mind is Owen, Illinois, which was one of the major bottling manufacturers in the country, sitting in an oligopoly market structure, ran a sales process. That was actually sold to the Pratt Group, and in many respects, and that needed quite considerable reinvestment to take it to the next level. Lots of private equity looked at it. I think they found it very difficult. They loved the asset, but the quantum of capital that needed to go into it did not give them the return they required in that 3 or 5 year period. But the Pratt family, like through Fizzy, could take a very long-term view, deploy the capital, and they're comfortable operating that market structure. So that may or may not have been an appropriate asset for LTPC to go into, but it's that type of mindset that we can bring that can create very good sustainable businesses.
Yeah. Now, we talked a bit about the long-term time frame, and there are a lot of benefits of taking a much longer time frame when you're investing. But sometimes you just need to get out. Can you tell us a little bit about the liquidity? I mean, are you locked up for 15 years, or what is the liquidity profile?
Well, I think two things. One is before I address the liquidity point, you're right. There are some times with particular investments it makes sense to get out. So I think it's what is appropriate for LTPC investment managers is they need to bring the disciplines you see in traditional PE and re-underwrite the investment every year. So you understand what you're carrying it at, and you truly know that it continues to make sense to hold in a long-term portfolio. The other benefit of doing that is, should you receive an approach for the asset, you know what you think it's intrinsically worth to you. That doesn't mean it's not worth something more to another acquirer. So, for example, if we had an asset and we thought it was worth 100, but if another acquirer who's a strategic buyer came along and knocked on our door and say, we'd really like to buy this asset, it fits well in our portfolio, we're prepared to offer you $200 million, we would move to transact on that really quickly because we're given the premium, because that's the right thing for our investors, and then we would give the money back to the investors at that point in time. Different funds have different mechanisms. Some don't provide for liquidity along the way. Some others do, so there are a range of options, but a potential feature of a long-term fund is that after year 5 there can be liquidity mechanisms where market makers can be appointed, and those investors who would like some liquidity can inform the investment manager that they would like to sell some of their exposure, and then the market maker, which would most likely be a placement agent, would seek the secondary liquidity for the investor. And that could happen. Liquidity could be sought for a number of reasons, Walter. It may be that the fund has actually grown quite large, and from a concentration point of view, the LP is looking to reduce the exposure there, or LPs have very dynamic portfolios, so there might be other reasons why they would like to lighten off. But by the same token, for others who may wish to have some more exposure, the secondary market mechanism allows them to increase their exposure.
Yeah. We got 2 minutes left, so I might finish up with a little bit more of a philosophical question. There have been discussions in the investment industry around companies staying private for longer. Some people have questioned some of the mechanisms in the listed markets. This strategy obviously fits sort of well within that idea that there's more opportunities in the private sector. But what is your idea about that trend that companies tend to stay private for longer? Does that give you more opportunity, or what are your thoughts around that?
Yes. So look, I think a lot of what we're hearing at the moment, Wouter, relates to the more on the venture capital scene, where people have been staying private for longer rather than seeking liquidity through the listed market. And that clearly underscores, in some respects, what we're talking about is that enables the management team to focus on growing the company and delivering shareholder value. If you ever talk to a listed company CEO and CFO who have gone from a private sphere into the listed markets, they will say they now spend 60% or more of their time on investor relations. So that's quite a distraction. And so if you then translate that into what we're seeking to do, it's not dissimilar, although it's in a different context of the venture capital or the listed companies. We will have appropriate board structures, we'll have appropriate governance, we'll be fully legally compliant, but the discussion will generally focus on how's the business been performing, what has driven the current performance, what do we do next, where's the investment need to go. So it's quite, it's fully focused on that. without a lot of the distraction that comes through from public markets. And look, there's probably a range of companies, you know, of a certain scale that they are actually much better sitting in the private market than running the compliance costs of being public. You know, if you're a BHP or, you know, Commonwealth Bank, like the listed markets is probably definitely the right place just from the size of the investment required. But you're an enterprise anywhere between, you know, up to $1 billion in market cap, you know, maybe you're actually much better off sitting in private hands because you'll get better focus from the investors through the general partner.
Yeah. And with that, our time has come to an end. So thank you very much, Jeremy, for your presentation and for your answers. And also thank you very much to IFM for this webinar. And to our listeners, thank you for dialing in, and we hope to see you next time again. Thank you very much.
Thank you, Val.